China has suspended soybean contracts with North Dakota, leaving American farmers looking for other markets. The U.S. agricultural business is losing ground to Brazil and Argentina, while China has reduced its imports to $34 billion, down from $43 billion last year. This decline has been especially dramatic for soybean imports from the United States, which have fallen from 40% of China's total soybean imports in 2016 to just 18% in 2024. The trade war between the United States and China started in earnest during Trump's first term, in reaction to U.S. tariffs on $370 billion in Chinese imports. Beijing replied with duties of up to 25% on more than $100 billion in U.S. imports, concentrating on vital agricultural exports such as soybeans, cattle, pork, wheat, maize and sorghum. China's plan for reducing reliance on U.S. agricultural imports has been varied and intentional. In August 2019, China banned sales of U.S. agricultural goods in response to tariffs imposed by the Trump administration. By 2021, China has begun commercial experimental plantings of genetically modified maize and soybeans, indicating an effort to enhance local output. In April 2021, China passed an anti-food waste legislation to avoid grain waste, emphasizing the country's commitment to food security. In February 2022, China permitted wheat and barley imports from all areas of Russia, the world's largest wheat exporter. In March 2022, President Xi Jinping told political advisors that China must depend on self-sufficiency and feed itself if it cannot hold its own rice bowls. This proclamation reaffirmed China's commitment to agricultural independence. China has established a soil conservation legislation to maintain crop yields in important agricultural areas, with the goal of increasing domestic output by correcting decades of soil degradation caused by rapid industrialization and pesticide usage. In April 2023, China announced a target to cut soy meal ratios in animal feed to less than 133% by 2025, from 14.5% in 2022. The nation also legalized microbial proteins for feed and launched pilot programs to utilize waste food and animal corpses as livestock feed. China's effort for agricultural self-sufficiency culminated in the passage of its first food security legislation on June 3, 2024, with the goal of achieving complete self-sufficiency in basic cereals and food production. The effect of these policy changes on U.S. agriculture has been severe, with the U.S. Department of Agriculture anticipating a record $42.5 billion agricultural trade imbalance in 2025. This imbalance reflects a significant shift away from America's historic role as a global agricultural leader. The collapse in U.S. agricultural exports to China is most visible in major commodities, with maize shipments to China falling 71% by September 2023 and soybean exports plummeting 133%. Brazil has emerged as the biggest beneficiary of China's move away from U.S. agricultural imports, accounting for 76% of China's soybean imports in 2023, up from 46% in 2016. The economic effect has been severe for U.S. farmers and rural communities, with yearly losses ranging from $3.6 to $5.9 billion in soybean output value and $0.9 to $1.4 billion in maize losses. According to studies conducted by the National Corn Growers Association and the American Soybean Association, soybean prices have fallen 0.6 to $1 per bushel, while corn prices have fallen 0.08 to 0.13 per bushel from baseline values. South America produces an enormous amount of soybeans, and more tariffs would be very destructive to the situation. The agricultural landscape is diminishing, with forecasts indicating a decline of 1.3 to 2.2 million acres in U.S. soybean production. This downturn spreads across rural towns, hurting everything from equipment sales to transportation services. Deere & Company reported lower demand for tractors and combines, while rural transportation providers see lower cargo volumes. Trump's planned trade policies might deepen their economic troubles. Trump has promised to charge a 60% tariff on Chinese products and at least a 10% tax on all other imports during his second term. The issue in Washington is that electric cars and some of the software that powers them may be able to gather personal information and share it with the Chinese government or, at the very least, the firm that manufactures them. Two U.S. administrations have hampered China in ways that Trump originally envisioned. China's strategic planning goes beyond cutting imports from the United States. The government is aggressively pursuing self-sufficiency in food production, investing in agricultural technologies and infrastructure, and diversifying import sources. Chinese livestock enterprises are altering feed formulas to minimize soybean meal use, while government regulations encourage local production using authorized genetically modified types. The worldwide ramifications of this change in agricultural trade patterns are considerable, since China relies on nations such as Brazil and Argentina for agricultural supplies. Once tariffs are abolished, farmers may struggle or be unable to reclaim lost market share. Reduced soybean and maize exports diminish U.S. economic production by $4.9 to $7.9 billion per year. The agricultural slowdown extends beyond farms, with rural banks reporting rising loan defaults, grain storage facilities working below capacity, and younger generations abandoning farming towns. Every agriculture-related industry feels the effect, from fertilizer providers to transportation firms to local businesses. A recurring tariff-based strategy drives farmland conversion in South America, with long-term implications for global soybean and maize exports. The persistent struggle of U.S. soybean farmers contrasts sharply with South America's increasing dominance. Brazil and Argentina are not only increasing output but also transforming their agricultural infrastructure, with new ports, enlarged railway networks, and modernized storage facilities reinforcing their position as China's preferred suppliers. Since 2018, Chinese corporations have invested in South American agricultural infrastructure, decreasing reliance on the United States. Argentina has become Argentina's second biggest trading partner, accounting for a significant portion of the country's exports and imports as China expands its manufacturing capacity and turns to high-end goods and services. This dynamic is critical for Argentina's economy, especially given its continued struggles with inflation and debt. State-by-state repercussions highlight the severity of the issue, with Minnesota and Wisconsin farmers' unions noting ongoing difficulties in recovering from the original trade war. Rural areas are experiencing diminishing demographics, lower tax revenues, failing local businesses, and sales losses. A massive gold mine with estimated reserves of over 1,000 tons has been discovered in central China's Hunan province. The Hunan Provincial Geological Bureau discovered approximately 40 gold veins with a total resource of 300 tons at a depth of 2,000 meters under the W Gold Field in Peking-Jiang County. The site's gold deposit at 3,000 meters deep is expected to be more than 1,000 tons, worth $600 billion. China's finding is a watershed moment in the resource race, establishing China as an even greater force in the precious metals market state. China is already the world's greatest gold producer, accounting for almost 10% of global supply in 2023, but its demand for gold significantly exceeds its production capability. China produced 268.7 tons of gold in the first 3 quarters of 2023, but used 7,417.32 tons. This enormous disparity has led China to depend primarily on gold imports to fulfill local demand. The People's Bank of China, PBC, has purchased gold for 17 consecutive months, the longest stretch on record. Some observers believe that China's gold purchasing frenzy is motivated by a desire to reduce its reliance on the U.S. dollar as a reserve currency, particularly after Washington weaponized the greenback in its sanctions on Russia. However, market analysts believe that China will have to keep with the U.S. dollar as its primary reserve currency, since it presently has more than $3.2 trillion in forex U.S. dollar reserves as of 2023. Chinese consumption of jewelry bars and coins has reached all-time highs, fueled by the concept of a secure sanctuary for customers. The finding of 1,000 tons of gold in China might possibly close the production-consumption gap and lessen China's dependence on gold imports, drastically altering the dynamics of the global gold trade. The technology underlying this finding is astounding, as the Hunan Geological Bureau identified and mapped these gold veins using modern research methods, including 3D geological modeling. This technical development has far-reaching ramifications, creating new opportunities for mineral exploitation across the planet. Economically, this gold discovery has far-reaching consequences for China. It signifies a considerable increase in its material resources and may improve its position in global mineral markets. Reduced dependence on imports is expected to improve China's trade balance and economic security in the precious metal industry on a global scale. The entrance of such a big amount of gold into the market has the potential to put downward pressure on prices, but the actual effect will be determined by a variety of variables such as extraction rate, global demand, and overall market circumstances. From a geopolitical standpoint, this finding is consistent with China's overall resource policy, indicating China's dedication to safeguarding its resource base and lowering susceptibility to foreign supply chain disruptions. The finding has elicited emotions from all around the globe, with some seeing it as a sign of China's geological richness and technical skill, while others regard it as a possible threat to the global gold market's current order. The United States is keeping a careful eye on the issue owing to its own interests in the gold sector and wider economic rivalry with China. Long-term prospects for China's gold sector are promising, with enhanced exploration methods resulting in more substantial penalties. However, mining gold from depths of more than 2,000 meters has substantial technical and economic problems, including extraction costs, environmental concerns, and the time needed to create critical infrastructure. As the global gold business transitions to more sustainable methods, the gold mining industry must adapt. China's commitment to exploiting these new deposits in an ecologically friendly way may create key precedents for the sector. The implications of this revelation reach beyond the gold market, impacting larger economic strategy, especially in nations with large gold holdings or highly invested in gold central banks. This finding emphasizes the continued relevance of natural resources in global economics and geopolitics, reminding us that physical resources continue to shape economic power and international relationships. The discovery of China's gold deposits in the United States has the potential to transform the economic power dynamic between the two global heavyweights. The United States has huge gold reserves, estimated at more than 8,000 tons, but China's recent find may drastically reduce the gap between the two nations' gold stockpiles. This might have an impact on currency stability and international trade discussions. The worldwide response to this finding has been divided, with some nations seeing it as a chance for greater collaboration in the mining and technological industries, while others are worried about possible market upheaval. International organizations such as the World Gold Council will play an important role in monitoring and analyzing the effect of this finding on global gold markets. Investors should exercise caution since the gold market is notoriously volatile, and this revelation adds to the uncertainty for individual investors. Gold remains an appealing alternative for portfolio diversification, but the possible rise in supply may have a long-term impact on gold prices. This finding is anticipated to have a substantial impact on the long-term forecast for the global gold industry, strengthening China's position as the world's top gold producer and consumer. This might result in changes in global gold trading patterns, as well as implications for currency markets and international trade ties. The finding poses both difficulties and possibilities for the United States, which may lose its relative position in the global gold market while benefiting from enhanced price stability. Companies that specialize in innovative mining technology may discover new prospects in the Chinese market. As the situation evolves, investors, legislators, and industry stakeholders must keep up with the newest developments. The future years seem to be an exciting time for the global gold business, with this finding possibly acting as a catalyst for big changes in how we value and use this precious metal.